So, welcome everybody to our webinar today, where we will be talking about transition plans and transition plans' role in the green transition, particularly in emerging markets, as we have two emerging markets experts with us today, which I'm very excited about. So my name is Rachel Hemingway. I'm the head of the transition program here at the Climate Bonds Initiative. We've been working on transition now for a number of years in recognition that we really need to make a step change in how we think about a transition to a climate neutral world, or a 1.5 degree future. And that transition is going to be bringing the entire economy along with us. So we're talking about transition of full companies, not only separate green projects, but how a company, how an economy, how a country can identify their path forward to decarbonisation, how they can identify the measures that they need to take to achieve alignment with that pathway, how they're going to measure progress along it, and how they're going to be reporting and managing all those internal and external governance structures and reporting measures. We need to change. We can't stand still anymore. We've been seeing floods, fires, disasters around the world. There's no time to lose, essentially. We have to have front-loaded change. We have to make some big cuts, and the longer we wait to act, the harder it's going to be and the more expensive it's going to be to take that action. So I'm really pleased to introduce my fellow panelists today. We have Anna Creed, who is our Director of Thought Leadership at the Climate Bonds Initiative, and she has been the author of much of our work and thinking on transition and transition plans. We have Berit Lindholt Lauridsen from the International Finance Corporation. She's a senior climate finance specialist with IFC, working in this space with a focus on emerging markets. And we have Nazmira Mulla, last but not least, who is the senior climate finance specialist for 91, the director for 91 on climate finance, also with a focus on emerging markets. So 91 is a global asset management company. IFC is a multilateral development bank, and we at Climate Bonds are a non-profit focused on developing definitions and supportive policies for transition. We will have some time for Q&A at the end, so please do pop your questions in the chat as we're going along, and we'll get to them as we can. And with that, I would like to hand over to my colleague Anna, who will be talking about Climate Bonds' work on transition plans. So, Anna Creed, over to you. You're on mute, Anna.
Thank you, Rachel. I did see the slide pop up, but then it disappeared. Brilliant, thank you. Yeah, so as Rachel says, we've been engaged with transition finance for a number of years now. We started back in 2019, 2020, when transition was emerging as a distinct label in the finance space, and we really want to support that. As Rachel says, it's very important that everybody is involved. Everybody needs to make a transition. Some people have got to do a bigger transition from a higher emissions starting point than others, but everybody is making some sort of transition, and we wanted to support that to really achieve a net zero economy. But as always at CBI, we want to ensure there's high levels of ambition and no greenwashing in the transition label or any transition finance or action. So we started back in 2020 in our first paper, trying to set out some principles for a credible transition, really about robust targets and standards, and also trying to categorize different types of transition that corporates might be making. Effectively, some people are scaling down, phasing out stranded activities, ramping up activities which are compatible with the low carbon economy, and decarbonising existing high emitting activities that need to substantially reduce emissions to get to a net zero target. So all the different types of strategies and how that plays out across different activities in the economy, essentially. And how, connected with that, how the transition label might be used alongside a green label. So that was our first bit of thinking in around about 2020. Then in 2022, we put out a revised paper with hallmarks for a credible transition, really talking about performance targets and plans and governance to deliver emissions reductions to meet those targets. Basically, what we now would call a framework for a credible transition. And earlier this year in April, we expanded our certification scheme. Previously, we've been certifying use of proceeds bonds and similar instruments. Now we can certify corporates based on their ambition and their robustness of their transition plans. And we can also certify any general purpose debt that they might issue, including, for example, SLBs, sustainability-linked bonds, and sustainability-linked loans as well. This certification builds on the hallmarks to a more granular and detailed set of requirements listed in our certification checklist, which is that little picture on the page. It's a document on our website. And as always, certification represents a high degree of environmental due diligence with third-party verification by one of CBI's approved verifiers to avoid doubt and provide comfort to investors and other stakeholders that actually the targets are ambitious and the plan to deliver it is credible. Therefore, we might say that certification represents something of a gold standard, and it goes alongside other assessment schemes and services such as the ACT, TPI's assessment of parts of transition plans. Rating providers are increasingly moving into this space with assurance and assessment services and second-party opinion providers as well. So now what we wanted to flag today is the new document we have recently released, the guidance to assess transition plans. This essentially supplements, if the certification and the checklist for certification is a kind of gold standard, on the hallmarks was a description of a broad framework. What the guidance is guidance for other stakeholders, such as financial institutions that might be developing their own net zero targets and client engagement strategies to support them in carrying out their own assessments as needed for corporates not yet assessed under the certification scheme or ACT or others. So this is what our latest document is about. And key to all of this discussion of transition, if I can have the next slide, please, Barney, that would be great. Is really about transition plans as a core tool for transition. And why they're a core tool? Because accelerated action really depends on developing, implementing, monitoring and updating robust and ambitious plans. They're also key to raising finance for the transition, as they enable the capital market actors to identify and directly finance credible investments and credible corporates, particularly as those financial institutions are setting their own net zero targets and strategies, and particularly interested in the implied emissions and transition in their portfolio. And of course, obviously, the creation of transition plans is aligning with various regulatory requirements and developments emerging globally, calling for corporates and financial institutions to disclose their transition plans publicly, including in the EU with the European Sustainability Reporting Standards. So transition plans are core to the regulatory requirements, to financial institution requests and requirements, and to corporate action more generally. Beyond that, to actually deliver transition in the real economy in the real world. So obviously a transition plan, just to recap, is a time-bound and trackable strategy and roadmap presenting the milestones and actions for reducing emissions with a science-based pathway to net zero. And what are the key components of that? Well, CBI articulated this first in the 5 hallmarks, like I said, which together constitute a AAA framework covering ambition, action, and accountability. And there's 5 hallmarks that we commonly talk about. Hallmark 1 is the ambitious performance targets, which set the goal for positive change. Generally, we would talk about reduction targets here, but actually I like to see other as well relating to biodiversity or circular economy or all the other environmental and social goals we need to also be tackling, as well as emissions reduction. And those performance targets should be covering all the activities and all the impacts of an organisation, and ambitious enough to actually meet our collective goals under the climate change and biodiversity and other agreements as well, in line with the science-based guidance. The second hallmark is really around the robust plans to deliver against those targets, which is about strategy and associated action plan with achievable and trackable milestones detailing how the company will deliver on its selected performance targets. And these kind of transition plans need to be fully integrated into the company's wider business model and plans. Hallmark 3 is about action. So that it's effectively that the strategy and the delivery strategies under Hallmark 2 are already being acted upon. So it's not about develop a plan and then don't do anything for 5 years. You actually need action from now. So there should be interim milestones within the plan that we can track over time. And they could be things like R&D or engagement with supply chain or investing in new capex and new technologies, etc. But they are interim staging posts that we can see actions being taken this year, next year, the year after, that will in time deliver the scale of emissions reduction that is needed and set out in the performance targets. Internal governance is really about the idea that the transition plan and implementation really will, for many companies, involve large-scale entity-wide changes, often reorientating their business away from one type of activity and towards another. And really robust internal governance structures need to be in place to be able to establish those plans, to be able to monitor them and their not just in terms of their delivery, but also their ongoing appropriateness over time with corrections and reviews as needed to keep them up to speed and up to date over the transition period. So really governance covers the internal monitoring, the accountability mechanisms and the leadership systems needed to drive the transition. And then last of all, we've got external reporting. I mean, this actually is the same as the green bonds market where we started, but it's the same message that transparency and external verification are critical for credibility. And really disclosure is also beneficial because it enables comparability across peers and allows global, national and sector progress to be assessed, which is important if we're trying to determine how well we are or aren't progressing in terms of the transition. Obviously, assessing transition plans is highly challenging. They're complex, they're comprehensive strategies, they're tailored to each organisation and the market and the geography that they operate in and the policy environment they operate in. They are, in many cases, like I say, designed to transform the whole business, deliver on technical performance standards. Therefore, they are very significant documents, and development of them is an engaged process within the organisation. Conveying that information credibly externally is challenging as well. And for people using those transition plans, it's tricky because information may often be unavailable, might not be public, and it might be difficult to piece together from multiple fragmented sources. So what we've done in the new guidance note is to try and distill from the hallmarks and from the checklist for certification certain green flags and red flags for guidance for what makes a stronger or weaker transition plan. I've just summarised those on this slide here. So the first one is about the performance targets. So on the green flags, we've got that they're full scope, which means they cover all material emissions across scope 1, 2 and 3. They cover all the activities of the company. And they cover a full timeline to net zero if we are talking about a full transition and looking at the longer term about are they actually going to meet net zero targets. We want them to be ambitious and science-based. So we need to, if we're talking about an emissions transition plan, which usually we are, that really is in line with the agreed goal to keep below 1.5 degrees collectively globally and aligned with science-based, probably sectoral pathways that enable you to benchmark yourself to show that you are actually in line with those targets that should be set for your activity in your sector. And also, like I've put beyond emissions address, we would like, obviously, if it's a particularly strong transition plan, that it is considering things other than emissions. At a minimum, the transition plan should be thinking about doing no harm to those other goals, but ideally should actually be how can we have co-benefits here that we can actually have performance targets, not just for other goals as well, just transition, the biodiversity, etc., etc. In terms of red flags, obviously anything that is not achieved on the green is by default almost a red, but some additional ones that the targets don't drop fast enough. So we do see corporates that have targets and they do that down to net zero, but the curve is not it's not steep enough, or it's too backloaded, even for compared to their own peers or their own sectoral pathways. So we recognise that some sectors will have more backloaded emissions reductions than others, based on technology availability or structural issues. But actually, according to the pathway for each sector, really you need to be making sure that you're moving in line with that pathway and not backloading your own emissions against that. And also that there's not an over-reliance on offsets. So a lot of the guidance around transition plan really talks about offsets being used just for residual emissions. And so not further than that. There should be a lot of emphasis on the emissions that you control directly under scope 1, but also under scope 2 and 3 through your engagement with your upstream and downstream supply chains. On the robust plans, I guess a key point here is this is difficult. This is where it does get a bit more qualitative, where it does get a bit more company specific. But a key green flag here is that there is internal consistency. So when in your delivery strategy, corporates are talking about the levers, decarbonisation levers they will pull, that they are internally consistent. They are feasible. And also that they add up to the emissions reductions set out in your performance targets, essentially. That's pretty critical. So it really aligns all the future activities, assets, and the business model with the performance targets set out above, and identifies the main levers of change that will enable that transition. And also that the plan is trackable. So people want to see that the progress is being made in the short term, the medium term, the long term. So there need to be identified interim milestones and metrics that can be tracked and monitored. That's a key part of a credible plan, really, so that it can be evaluated for progress over time. There should be a supporting finance plan, which obviously covers the cost of transition, any potential sources of finance of that, but also thinks about the impacts on the financial position of the organisation as a whole. Obviously, we're talking about changing the operating model of some of these businesses. It's going to impact revenue negatively in some senses, which need to be counterbalanced by positive revenue impacts elsewhere. So really want to see the financial impacts in the context of the whole organisation, not just CapEx costs of transition, for example. And also in terms of detail on a transition plan, where its uncertainties, its sensitivities, its possible weaknesses. None of this is going to be perfect. It's all looking forward. It's very difficult to do, to predict into the future. This is a best case, credible case of this is what we think we're going to do. This is what is achievable. But some of those assumptions will be more variable than others. And it's really critical for transparency that those uncertainties are clearly disclosed, and the impact of those, if something doesn't pan out in the way that it's expected, is disclosed as well. So there's full visibility on the likelihood or sensitivities involved in the transition plan. And again, we would like I said above in the performance targets, we would really like to see that the transition plan also addresses how risks to other environmental and social factors are going to be mitigated through the implementation plan, and ideally how co-benefits are maximised, essentially. So that needs to be action plans that need to cover those other aspects beyond emissions as well. On the action, really, this is one for over time, in a sense that we want to see that there is delivery against the interim milestones that have been set. If there is underperformance, and there probably will be, things won't go entirely to plan, that underperformance is recognised, it's acknowledged, and there is a mitigation strategy in place to correct with some other action or some other strategy that can actually correct that situation and address that going forward. So we are not on a downward trajectory, we're on an upward trajectory in terms of progress, essentially. And then lastly, sort of the associated underperformance on that one, associated red flag on that one is that if there's consistent underperformance over time, that it would be a big red flag for us, that action's really not being taken, that things are not being corrected, etc., etc. On the governance side, like we said, governance is really critical. It's some of these transitions are going to be quite fundamental to the organisation. They need to have ownership from the top, with the board and the senior executive, the board signing off on the transition plan, having continual oversight of progress and delivery, and any corrections that are being put in place, reviewing the transition plan regularly. And similarly, the senior executive have the mandate to really go out and deliver against the goals and the strategy in the transition plan. And that there are governance mechanisms that enable them to do that, so they can track progress, so they can see what is working and not working in the delivery of the transition plan. Some aspects on the red flag side here would be that there are no public commitments at all on the interim stages of the transition, and that there is, like I say, persistent underperformance, which suggests that something is not right in the governance, even if the delivery strategy and the plan was great, but obviously the delivery ability internally is lacking if there is persistent underperformance. And lastly, on the reporting, the smaller one, we want to see the key stakeholders are very interested that key information is disclosed about the transition plan, and ideally that it's externally verified. The transition plan and potentially also the emissions profile at the start of the transition, or the period at which the transition plan is released, and a commitment as well to annual reporting and verification going forwards. This is difficult because some of this information might be commercially sensitive, but there's a lot of guidance out there now on actually what is the information disclosure requirements that people would like to see or should be expected to be seen. And one thing I didn't mention earlier, but it's to make sure really that information is disclosed in a way that's quite tangible, so people can put the transition together in terms of understanding what it is. It's not too vague, it's not poorly expressed, and it is actually tied to concrete measures that can be monitored and measured over time, essentially. So I'd say those are the green flags and red flags. And last one, yes, some other work that we're doing on assessing transition plans. So we're collaborating with a number of organisations, including 91, to try and develop a tool for financial institutions to make assessments of corporates' transition status across their portfolio based on the limited information that is actually available to them today. So this will again take from the guidance notes and the checklist and try and distill that down into sort of key indicators with as much precision in terms of quantifiable metrics as is possible to do. So that's a goal at the moment in terms of developing this assessment tool, this navigation tool that we're working on bringing out by January next year. And secondly, there is a very interesting initiative that's being convened by the World Benchmarking Alliance, and they're convening a lot of organisations that have contributed either to assessment schemes or standards like CBI or other guidance and frameworks around credible transition and credible transition plans to really focus on the assessment of those transition plans in a similar way here, so that we can get some sort of commonly endorsed guidance on how to credibly or how to assess a credible transition plan effectively in the market to be useful and practical as we move forward and we see more and more transition plans coming out. So that's it from me. Thank you.
Thank you so much, Anna. For time, I think we'll just move directly over to Berit and take questions at the end rather than stopping to have some Q&A at the end of each person. So if we can hand over to yourself, Berit, to take us through the work of the IFC on transition and how you guys are thinking about it over there. Thank you so much, Anna.
Thank you, Rachel. So for those of you who may not be familiar with IFC, it's the private sector arm of the World Bank, and it's the largest global development institution focused on the private sector in emerging markets. So if we go to the next slide, you can see on the chart on the right-hand side that it speaks its own clear language. We're off track, and the deep emission reduction cuts across all sectors are urgent if we are to meet the targets of the Paris Alignment. This will have clear implications for businesses, and all companies will be affected one way or another. So while we, the past decade, we have seen a significant increase in green and sustainable investments, we need to recognize that a fully decarbonized world by 2050 is not reachable solely through the finance of green projects. We need to look beyond the individual project and actually to the corporate. And widespread investments will be needed to transform the entire business model, systems, and industries. International Energy Agency has estimated that by 2030, the climate investment need to increase to about $2 trillion per year in emerging market and developing economies, which is about 40% of the global investment needs. And recently, the IMF estimated that most of those $2 trillion will have to come from the private sector, given the limited financial or fiscal space in many of these countries and the challenging market conditions at the moment. And if we go to the next slide, we can see the efforts that have been made by the ICMA and the principals in this space, because there has been and there still is a lot of confusion in the market about what is a credible climate transition. Investors are concerned about lack of ambition, financial risk of carbon lock-in and stranded assets, the reputational risk of washing or extending the life of activities that should be phased out. So to help facilitate and accelerate what's needed finance to enable climate transition, the principles and ICMA published the Climate Transition Finance Handbook in 2020, and it was updated this summer. It seeks to provide guidance and clarify expectations on the practices and the actions and disclosure needed when raising funds for a climate transition. You can see here that the pillars, the 4 key pillars, more very well aligns with what Anna has already presented. It's a question of having a clear strategy and the financial enable the issues decarbonisation strategy. It's a question of materiality. The climate trajectory should be material, relevant for the business model. And pathway and targets needs to be science-based. Finally, transparency is absolutely key to build the market credibility and integrity. So it's disclosure of underlying investment strategies and decarbonisation progress. If we go to the next slide, this is, as you may know, IFC has committed together with a number of other emerging MDBs, multilateral development banks, to Paris alignment. And that means that IFC is committed to align its financial flows with the goals of the Paris Agreement. It's part of the climate action strategy, and it is by July this year, 85% of all new operations in all sectors is to be aligned with the Paris Agreement's goals. And by July 1st, 2025, it's 100%. So what does that mean? That means IFC channels financed activities that are consistent with low carbon and climate resilient development pathways aligned with the objectives of the Paris Agreement and consistent with the client countries, the climate strategy, and the commitments. It addresses both the mitigation and the adaptation. We find that this Paris alignment commitment facilitates the conversation with emerging market companies about their transition to a low carbon future. This is kind of the starting point of how do we get started on establishing the transition plan, the strategy, the pathways, and the internal framework to actually tag finance as climate transition. If we go to the next slide, you will see that the expectations we have around climate transition finance is very much the same as Anna has already talked about. It's a clear decarbonisation strategy with a long-term net zero commitment and levers towards decarbonisation with an investment plan. It's the climate governance with a clear oversight and governance. And I have inserted here an IFC tool on climate governance, which actually provides a progression matrix on climate governance and can help companies assess their own governance structure and what it actually will take to be climate leaders. It's also looking at how to avoid lock-in in investments. And this is, for instance, relevant when you're talking about a fuel switch from perhaps coal to gas. We know gas is still fossil fuel. So if you were to make this fuel switch, which as part of a decarbonisation effort, you also need to think ahead and say, okay, so what's the lifetime of an investment in a gas? And what is the repurposing on it? So it's the discussion on when is it locked in and when is it stranded. Science-based pathways, it need to be short, medium, and long-term targets. They need to be credible and significant and ambitious, given the sector they are applied to and the geography of the company where they are operating. Targets should be publicly disclosed together with the pathway, and we would recommend to have an independent assurance on it. Transparency is absolutely key. It's reporting and audit of carbon footprint and reporting on performance, validated annually. But it's also a commitment by the company to consider climate-related reporting, similar to, for instance, what the recommendation of the TCFD is. So beyond looking at what is the carbon footprint and the decarbonisation performance, actually looking at a bigger picture of what is the risk and opportunities that climate means for the company, and what maybe not have been mentioned by Anna is that a transition pathway, as well as the transition plan, is a dynamic program that will need to be updated as we go ahead. Technology changes, climate changes. So it's an ongoing process to stay on top of one's transition. If we go to the next slide, you will see on the right-hand side what the opportunities are. The green bars are really gap vis-a-vis annual infrastructure investment needed. So these are the investment opportunities, and this is where private finance will be absolutely key. But we also recognize that financing climate transition in emerging market faces their own challenges. I mentioned earlier that about 80 to 9% of the 2 trillion investment needed will have to come from the private sector. However, we know already that many emerging markets, developing economies are below investment grade rating or have no rating at all. There is the foreign exchange challenge, and there is the uncertainty of the political climate or the climate policies of the country and the direction of there may be uncertain directions. There are unclarity on what's the policy around carbon pricing or carbon tax, and what's actually the regulatory environment that could underpin a transition. So in addition to these traditional credit risk, when we're talking finance of transition in emerging markets, is also a lack of data and a weak climate information architecture that makes it difficult to determine what is the decarbonization pathway, where is the company. This is still fairly new for a number of companies, that they are collecting GHG data and they may not have a long track record. They may not have the necessary value chain or supply chain of the data that they need to in order to estimate their own decarbonization pathway. It's as I said, a new thing in many of these markets, so they may not have the necessary know-how or the capacity on the ground to implement the decarbonization strategies and projects. And then it's also a question of incentive. I briefly mentioned there may not be the regulatory incentive in form of a climate or a carbon price or a carbon tax, and that means if you are invested in higher emitting assets, it may not make sense for you to invest in a newer technology that has a lower emission, because there is still fairly new and young assets. Access to capital can be a challenge in many of these countries, both from the credit perspective that we just talked about, but also because we see a global increase in demand for low emission technologies, renewable energy in particular, and that is putting a pressure on the price, which again makes it perhaps less accessible for emerging markets. Domestic economy may rely on emission-intensive sectors. The best example is perhaps those economies that are built around a coal industry, with coal mining and energy grid that is built on coal. This makes it can make it difficult for companies in these jurisdictions to change because they may be bound to the coal-intensive or carbon-intensive grid and may not be able to switch to, for instance, a renewable energy. So there can be limits to what their ability to actually decarbonize are. Finally, there is the socioeconomic concerns with the growth and the inequality. Again, it links back to economies that may be built around a coal or fossil fuel, where it can be difficult to create a just transition to a different economy and a different economic structure. But there can, in addition to that, also be the cross-subsidizing. Like, for instance, you may have a coal industry, but there is cross subsidies from the coal industry to the poor people of the country, and if you close down the coal industry, that will have implications for how you can actually provide support to the poor people of the country. So there are a lot of additional challenges for emerging markets, which means that when you talk climate transition, you need to look a little at what is the starting point of the company and what is the conditions under which the company operates. And with that, I think I will hand over to you again, Rachel. Thank you.
Thank you, Vera. I'm hearing a lot about challenges. There look like there are a lot of opportunities as well, and I'm conscious that Nazmira would like to maybe touch on some of those opportunities in the work that she's leading at IFC on transition as well. So I'll hand over to you. We have quite a few questions coming in the Q&A, which is fantastic. We will get to those as soon as we can, but First, I will pass over to Nazmira. To you.
Thanks, Rachel. At 91, Barrett was at IFC, but all
Sorry.
good. It's okay, don't worry.
It's been a long day.
I know, it's been a long day, so it's been a long year. So I think what may be helpful is to talk a little bit about how we are using transition plan assessment and how we hope this develops in the future. So as Rachel mentioned earlier, 91 is the former Investec Asset Management. We're a global investment manager, but we have roughly 55% of our AUM in emerging markets. So we have quite an EM lens when we think about climate-related issues and transition-related issues. And we signed up to Net Zero with the Net Zero Asset Managers Initiative in 2021. Set our targets in the middle of last year, and the targets that we've set are very much focused around the proportion of our corporate equity and debt holdings that will have science-based net zero aligned plans by 2030 and looking to maximize those. So it's a very engagement heavy strategy, very much avoiding divestment because we tend to believe that this doesn't have any impact on the real world. Selling your emissions to someone else, making up your portfolio, but doesn't actually do anything in the real world. So with that in mind, we had a look at our holdings across the house. So we manage roughly $160 billion, and we have 1,200 holdings across the house. And before I give you the number, let's take a minute for everyone on the call to just have a mental guess for the number of holdings that account for 50% of our financed emissions, including scope 3. Well, we understand much of that is model scope 3, but including scope 3. So if you've all got your guess now, I'm from past experiences of giving this pop quiz, the number I generally get back is somewhere between 60 and 100. And the answer currently is 24. So massive concentration of emissions in our portfolio. And, you know, the companies vary a little bit as you, because there's a large proportion of public equity and debt holdings, so they vary. But over the last 18 months, we've had 35 companies that have been in that 50% financed emissions list in total. So therefore, your ability to focus and engage is much higher than if you're thinking about a much broader tail. So the first thing we did was we developed a transition plan assessment framework. And we based it on a lot of what we saw available, but there's a remarkable overlap with the work, not surprisingly, with the work that Anna presented earlier. The 3 pillars of our TPAF is the ambition of the targets, exactly the same. And then we split the second slightly differently, which is the quality of the plan. And then the last is implementation. So the only difference is we leave implementation as action and governance, whereas action is brought into the second pillar of CBI. So pretty much doing the same thing with a bit of semantics. And so what we've done is we've assessed the highest emitters in our portfolio under this framework. And it's 39 indicators spread between those pillars with drop-down menus, red, green, yellow traffic light system for our analysts to fill out. And as I tell most of the analysts on our team, if you know the transition plan of your company, it should take you about 10 minutes. If you don't know the transition plan of your company, here's an opportunity to get to grips with it. Not surprisingly, given the focus has been on the highest emitters in our portfolio, there's a whole lot of red that comes out on the assessment. However, what we found useful in these frameworks is 2 things. One is it gives you a clear idea of where the red starts. Is it actually all the way at the beginning in that there are no targets? Or actually are the targets, you know, there's some green and there's lots of yellow there, and actually the problem is the plan, or there's beginning to be a plan and there's no implementation. And for many of them, there isn't a plan as yet. Again, no surprise, but we are seeing positive progress year over year. The second thing that we found useful is we identify what we're engaging on, because you can't engage on the whole lot. You can't sit in front of a management team of a company and say, I have 35 problems with you. Please, can you change them all in the next year? It is about saying, okay, if this company doesn't have targets yet, that's where the conversation is around. It's about the targets and disclosure. If they have longer term targets and they have medium term targets, but they have no idea on the financial cost of getting there, then that's where your conversation is. Governance is something that we also take seriously because it's all about accountability in the end. So that's been really helpful. So that's one area that we found using this transition plan assessment framework to be very valuable. The other main area of focus for us around our climate contribution has been allocating capital into where we think we can have a positive impact. And Anna mentioned earlier on the work that we're contributing to around transition categorization. And why we think that is really important is because there is a very broad understanding of what transition is. So as we look to encourage investments in transition, as we look to have institutional investors allocate to transition, there needs to be a common understanding of what that is. And therefore creating this common language that these are the components of transition, and while every transition fund may not include all of it, we at least understand what the building blocks are, and you can understand if a specific fund only invests in solutions and Paris-aligned companies, we know exactly what that means. So that has been really another focus area for us, and this idea of how you assess transition progress of companies feeds directly into that. And maybe the last point I'll make, Rachel, before I run out of airtime, is around this idea of how we then think about emerging markets in that context. So Berit highlighted many of the challenges of operating in emerging markets. And the first one is how do we think of what Paris alignment looks like for a cement producer in India versus a cement producer in Germany, where your fair share pathways will look different, but also your grid is considerably different. I know CBI has done a lot of work on trying to strip the grid impacts out, but that's what we try and think about when we look at assessing whether a transition plan is science-based and Paris-aligned. And what we're hoping is that as we go forward, the available market tools to do this will become increasingly transparent, increasingly broadly agreed upon, so that we all have a common understanding on whether an investment is transition aligned or not. Currently, it seems to be more art than science in terms of making that judgment. So we have spent a lot of time equipping our investment professionals to judge this. My team's currently running Transition School, sort of 2-hour deep dives into initially the technologies and now the sectors and what the pathways look like. I think we're doing batteries and EVs tomorrow. So, and maybe the final point is, I think what has been heartening for me is to see the number of companies, even in emerging markets, that are starting to actually embrace this as a commercial opportunity. Companies don't act because they think something is good. They act because they see a commercial opportunity. And what we're seeing is many, particularly middle-income emerging markets, companies moving ahead of their governments. So, for example, auto parts manufacturer Nemec in Mexico already has an SBTi target. Interestingly, looking at, and it also has a target to have 60% of their outputs going into the electrified portfolio. So not only dealing with 1 and 2, but dealing with what they're selling into as well by 2030, and then with the 2050 target in place. We can discuss other examples as well, but I think it's important that I leave your audience with the fact that emerging markets are very much part of this, and there are companies there that want to be part of that journey.
Thank you so much. So I have some questions from myself we have a whole bunch of questions in the Q&A, and I'll also try and get to those. But my first question is around, it's kind of a two-part question, and I'll throw this open to all three of you, because I think maybe all three of you have a slightly different view or a slightly different experience. So one, what, in your opinion, would be maybe the benefits of developing a transition plan for either a financial entity, because everybody needs a transition plan, including financial institutions, or a corporate either? And to what extent are you seeing at the moment uptake of this opportunity, like the opportunity of developing a transition plan in the market? So who are you seeing kind of engage with the opportunity presented by examining your entire company or your entire entity for alignment with a 1.5 degree future? So if this is okay, I might just kind of pick on people to answer, and I'll start back to front. So I'll start with Nazmira, as you've just given an example of one organization, and I was wondering if you've managed to pick up on some others and what you're seeing as some of the opportunities in this space.
So I think it's important we separate financial institutions from industrial companies. And the reason I say that is because the way to decarbonize the emissions of an industrial company are between its scope 1 and 2, which tend to be some reasonable portion, and then the scope 3 in terms of the products it sells or the historical supply chain. I think one of the conclusions we've strongly reached is the biggest contribution of a financial entity is not to decarbonize their portfolios in the short term. In the long term, we have to decarbonize the portfolios, but that's a reflection of the decarbonization of the economy, not ahead of the decarbonization of the economy. So that is one very strong conclusion, because what we've seen is that where financial institutions set linear decarbonization targets, they actually end up with counterintuitive results. You end up with dirty assets being left in hands of investors who care least about climate. So that's one observation. In terms of the companies that we've seen doing most outside financial companies, it's again where the commercial imperatives line up. So the mining companies who are seeing the energy transition as a significant commercial opportunity in the medium term are now scrambling to produce transition plans. I don't claim that they have aligned plans as yet, but there's a lot of discussion around what that looks like in management meetings. Cement companies are ahead of many on their 2030 targets. Well, some cement companies are ahead, but it's not only the global ones, because, I think we expect Heidelberg, or we expect Cemex, which may be Mexican in roots, but has global operations, to be ahead. But Ultratech in India is an example of a local EM company, massive local EM company, which is also doing a lot. So I think the suppliers in the space where they see a commercial opportunity and have demand from their customers, or where they're selling into Europe, is where you're seeing the most progress.
Interesting in the point on selling into Europe, because that ties in with the question in the Q&A about the regulatory space in Europe. But I'll come to Berit next on the opportunities and kind of what progress you're seeing in the market on this, because I am quite interested to see if things are moving or if we're still at the kind of the conversation stage. It sounds from what Nazmira is saying is that things are starting to move, but it's not across the board.
Yeah, no, I would agree with that. And I will start with the same distinction as Nazmira did, that there is a difference between real sector and financial sector. But if you look at real sector, I think you can actually compare it to when a company issued their first green bond. It forces them to think about how their sustainability program applies, what is green in their operation, what is not so green. And that's the same thing when you start thinking about what is a transition plan. It forces them to think about their operation. It forces them to think about the opportunities and the risk of climate change. So while it's early days, we definitely see the trends of they are starting to have a more coherent thinking and a programmatic approach to establish what does that transition plan look like. So it's definitely in development.
Thank you. The difference between financial institutions and real world, obviously there is a big difference, and the financed emissions is a very big part of that. But the scope 3 and the lack of control over some of the emission sources is also a really big challenge in some of the sectors, particularly if you think about agriculture. Is more than 90% of most of those emissions are scope 3. So I think some of the challenges in terms of not having full control over your emissions, and that really strong need for engagement with supply chains and clients and suppliers is quite common. Anna, over to you on the same point on opportunities and what you're seeing in the market.
Yeah, before I do that, actually, just picking up on your point about agriculture, I think there is a useful parallel, because if you think about the agricultural sector, the first point is, can they trace their supply chain, which is effectively what financial institutions are trying to do now. They're trying to look at what's in their portfolio and trace what emissions are associated with it and what transition plans are currently associated with it, so they can at least understand where their portfolio is, and like Nazmira says, start engaging with that to try and move it along to the next stage, development of longer term targets or more robust transition plans, etc. But a lot of it now is about traceability in a sense. So actually it's quite a good parallel with the agricultural sector. In terms of benefits of it, yeah, I mean, these are a bit opportunities kind of thing. I don't know how many people are actively acting on it, but getting ahead of the regulation. So we have seen that there is requirements to disclose about transition plans in some of the EU regulation and other jurisdictions globally. So some of those are subject to materiality assessments. They might not go as far as we would like, but they're definitely moving people in the right way. And I think that's going to be really critical, because there will always be people who will do this voluntarily, and there'll be a lot of people that wouldn't do it voluntarily. So actually having it in the regulatory space is a huge game changer here, actually, to get a lot more transparency from a lot more corporates is really important one. And some institutions will want to get ahead of that game and show that they are aligning and will be able to meet that regulation fairly straightforwardly. The other obvious one is people who want to distinguish themselves from their peers, essentially, or again, like Nazmira said, show that they might be in a sector that is perceived as being not that great on sustainability angle, but actually they as an individual organization are doing something about it within their own operations. So that kind of distinguishing themselves from their peers or within their sector is a really, really important one. And the other one, again, is because financial institutions are looking at their own targets and their own engagement strategies, actually they will be asking for corporates in their portfolio more and more questions about their transition. So that is another reason. I don't know how much it's driving people yet, but would definitely be another reason we'd expect these things to multiply out. And in time, maybe the old argument about preferential rates or even access to finance would hopefully flow off of the back of that transparency and engagement.
Thank you. You okay? I got another question here, and it's a kind of interesting one because we haven't really touched on it. And it's how can, and this is a question in the Q&A from Andrew Ross. It's how can cities and municipalities engage with this? Now, I know, Anna, municipalities are on your radar, so I might come to you, but I do want to ask Berit and Nazmira if this is something that is also kind of coming across your radar as well. Are you thinking about non-corporate finance in terms of transition? And if not, I'll just hand over to Anna, because I know she has started to think about this.
I have some small thoughts.
Fantastic.
But I don't know if Berit wants to go first.
As we have not a systematic approach from a climate transition perspective, but we do have a cities program where we are looking at building resilient cities, and that is building the whole city infrastructure, which you could say is part of the transition. So yes, there is the resilience program around cities.
So two observations. One is around we do provide we do buy municipal bonds in some of our regional portfolios, notably in South Africa. So there we are looking at what cities are doing, and the only one doing anything is Cape Town. So it's interesting to see that complete diversion, because, and I think what that's taught us is that municipal regulation really does matter for an ability to make progress within a city. And a lot of the energy consumption is at city level. So if you're going to think about regional transition beyond what your large companies can do, where they can build their own or they can procure their own that's wheeled, it does tend to then come down to that city level regulation. And perhaps I'm most au fait with this is our operations are about, we have about 35% of our people globally in Cape Town. And we have become the first purchaser of renewable energy wheeled across the Cape Town grid. So that was entirely driven by a change in regulation within the Cape Town municipality, and wouldn't have been possible without that. And I think what we've seen in a lot of the energy transition discussion more recently is the grids are becoming the biggest part of the discussion, and that's both the long distance networks, but the local networks as well, and that's controlled by the municipalities. So they have to be part of this discussion. So Rachel, the short answer is we haven't factored it into our transition plan assessment frameworks that we're doing for corporates, but it is in our thinking around how we look at the energy transition more generally.
Great. And there was the IEA report out recently that highlighted the importance of decarbonising grids and investment into grids to underpin the wider transition. So it's a particularly pertinent question. And I'll pass to you, Anna, to kind of finish this question off with some of your thinking in the area, if that's okay.
Yeah, thank you. Yeah, so at the moment we can certify corporates, but we're actually working on the rules at the moment so that we could municipalities or their debt if they were to issue any SLBs or SLLs, for example, and sovereigns and financial institutions as well, just to tack that on as information. But on the municipality side, but also for the sovereigns and the FIs, I've been thinking about this a fair amount. This structure still works. So if we're talking about a municipality or a sovereign, we still need to look for performance targets that are ambitious and science-based. We still need to look for robust plans. We still need the interim trackable markers and progress against those. We still need the internal governance that they're going to be able to deliver. And we still need the external visibility through disclosure and verification. And a lot of the granular things underneath each of those 5 areas. All of that is pretty much transferable to different types of entities. The interesting bit is mostly around what are the targets for municipalities or other types of entities. So in the municipality space, when I talked earlier about one of the green flags is sort of comprehensiveness of the targets. So scope 1, 2, and 3, that's probably still a given. But even, are we just talking about the targets, the assets that they own or manage or can influence directly in some way? Or are we talking about the city footprint as a whole? What does comprehensiveness mean for a city when we'd actually be evaluating it? And that ties a bit to that interim step. They've got assets that they own and manage themselves. Great, they're a bit like a corporate in that sense. They also can influence the city through policy or through building codes or whatever it is. That's also important as well. So maybe we should evaluate them on that. Should we evaluate them on other things happening in the city that they have? So really the scope of what the targets need to do, and also the trajectory of the speed of the emissions reductions in a city. If you just think of it, it's like the ultimate conglomerate. Well, I suppose a sovereign is the ultimate conglomerate, but it covers a number of different sectors. Where's good performance? What sort of speed of change we want to see, and what's good performance for a city that's got buildings, transport, water infrastructure, everything else? What do those targets need to look like in aggregate, and when they should be net zero? So here we're looking at other initiatives around net zero cities and how we can use that to set. I think one thing that's challenging about certification is we always have to say yay or nay, you can be certified or not, which actually means we need a decision point at some point to say it's good enough. And I think that's where it gets difficult. The framework is good. There's a question about the scope that we might need to look at for a thingy, but actually where do you set the threshold to say you're moving fast enough? And how do we make that flexible enough for all the different cities with different asset pools, different levers of change in different jurisdictions, etc. So that's a bit more complicated than it is for a corporate. But anyway, well, yes, we're on track with trying to work out those rules, but that's our thinking so far.
Great. We are at the hour, unfortunately, because I feel we could have continued the conversation almost indefinitely, because there's so much to talk about. But what I'm getting from this is essentially watch this space. There's a lot happening. More and more guidance is going to be coming out with regard to transition plans. as well as the number of transition plans that we're seeing in the market is going to increase. So it's an active space. We're thrilled that there's so much interest in it, and I would just like to say a great big thank you to my fellow panelists, Berit, Nazmira and Anna, and to our Climate Bonds team who put this webinar together. So thank you very much. Please do feel free to follow on LinkedIn and share any additional questions, and we'll try and get back to those that we didn't answer. So with that, thank you very much, and goodbye from us.